on Wall Street and on Main Street, where we're seeing a sharp rebound in sentiment. I showed you at the beginning, it's worth showing again. US markets are at record highs. It was a rough start to the year, but they both touched intraday records. The best performance is on the NASDAQ, which is up 1.5%. And in the real world, the University of Michigan's latest consumer sentiment survey shows Americans are feeling much better about the economy. That figure shot up 29% in the last 2 months. Look at that graph, and you can see how inflation really beat the bejeebies out of the consumer. Now it's started to move back up again quite sharply, the biggest jump in decades.
Some of these chip stocks have just gone crazy. We talked about AMD, right? It was up 80% in 3 months. You're like, I got to get out of this. This is just insane. ARM today is up 38%. Now it has a bigger market cap than Micron.
But
Professor, you're having to change your numbers every time we speak. The last time we had a conversation, right? It's incredible. The last time we spoke, but a couple of Fridays ago, I think, you said, well, we could do another 8 to 10%. Well, now the market keeps going up. Well, we could do another 5 to 8%. It's remarkable. Your thoughts as we close in on history?
Well, yeah, I mean, happy days are here again, as they said in the 1920s. This is the 2020s. And my roaring 2020 scenario is almost on steroids here. I've been, last year I was talking about 4,600. By the end of last year, we got there by July. This year I've been talking about 5,400. And here by the end of this year, we're already at 5,000. So it's been phenomenal.
I do want to talk a little bit about 2025 because 6,000 is a staggering number and 2025 feels very, very far away. What is the work that gets you there, and how do you project that with a certain degree of confidence?
Well, first, on a short-term basis, looks like there's still some what I call die-hard hardlanders who think that we're going to have a recession next year.
Fresh out of college, Steph Patenaude co-founded white-hot internet company theglobe.com, or T-Globe.
She needs to talk to him so we can coordinate some deals in LA. Okay.
Shares opened at $9 and jumped to $97 on its first day of trading. Then, Steph Patenaude was worth close to $100 million.
Could it see 7,000 on the Dow now that we're almost 11,000? Yeah, it could. But then it'll probably see 15,000 by 2005.
15,000 by 2005.
Yeah.
That's so another 50% gain.
Yeah, another 50% gain, I think, is actually a very conservative forecast. And that's mostly because I think that the market is a little overvalued and is due for correction. But I think we are in a great bull industrial revolution for the global economy and a great bull market in stocks. I think the internet technologies, the technology revolution has already created an enormous amount of prosperity for all of us worldwide. I think that's just going to continue. There's no reason why we couldn't extrapolate that to the moon at this point.
But you've got to be perverse to say the market's going to crash. It may correct, it may have a major correction, but with low inflation, low unemployment, low interest rates, strong corporate earnings, I would be a certifiable lunatic if I said the market was going to crash.
Is there a bubble going on in internet stocks?
I don't describe it as a bubble. There's a phenomenon with internet stocks versus all other stocks. That's been going on since the internet started. That phenomenon continues. As long as people are inspired and think that the internet is something huge and different, the valuations will continue to be huge and different.
You know what? It is no different than when the cable industry started. It's no different from when the first television networks started in the early 1900s. The reality is anytime you have a new set of companies that can capture the potential for a massive audience, they're going to see those high valuations because they can have access to all these users.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets. This closing bell might as well have been an alarm, so savage was the selling. In percentage terms, it had less impact than the crash of '87, but it still left traders and investors shell-shocked. The plunge was sparked by a jump in US inflation, the fear a bigger hike in interest rates the only remedy. It was enough to force the Dow Jones down 616 points, a drop of 5.5%. The fragile technology stocks even harder hit, the Nasdaq index in freefall down nearly 10%. It lost a quarter of its value in just 1 week.
Steph Paterno was worth close to $100 million. Today, his shares are worth under 20 cents apiece, which makes Steph worth
almost nothing. That's the sad part of it all.
And yeah, you can, round up the usual suspects on Wall Street, and you can round up the usual suspects in Silicon Valley and the venture capitalists, but, I don't think there was any real villains here at all. I think it was just a mass delusion.
The old timers like us wait for the day of reckoning. Wait for these people who are speculating to be smacked down. Everybody's invested, everybody's happy, everybody's making money. Something's wrong here.
All right. Today is Sunday, the 11th of February. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. Hope you enjoyed the Super Bowl now that the most popular show in America is over. Welcome to the second most popular show in this country. And many others, by the way, not just this country. In any case, folks, I think after the action that we got in, let's say, last week, the last couple of weeks, the insanity that we've seen in the stock market, a lot of folks are now convinced that this is unlike a healthy bull market where we see inclusive rallies with moderate temperament. This one is a bubble where we see concentrated rallies that go out of whack. We hear outlandish commentary, out of whack predictions and numbers. In the dot-com bubble in '99, they said, Dow 36,000 is the next stop. Well, they got there 25 years later, after a nasty crash, of course, and stagnation for years. But back then, everybody thought that this is the new normal, this is the new millennium, this is the new technology, the internet is going to change the world. Yes, it did. But when expectations go outside the realm of reality, things come down crashing, even though the technology is here to stay. And we see the same thing here in this AI mania, which is, by the way, not an idiosyncratic mania that was born in '23. It was a result of the greater bubble, the greatest bubble of all time, the liquidity bubble that began in 2020, where we've seen blow-ups. And this is the last one standing, and once it's gone, it's over, the bubble goes bust, and we see the lost decade, even though AI will still be with us and will dominate business for years to come. But again, it is a character of bubbles. We hear outlandish commentaries, and numbers go out of whack, the latest being this week. You might have heard the news that Sam Altman, the founder of OpenAI, now wants to raise up to $7 trillion to manufacture chips for AI. And he said that with a straight face. This is an illustration of the lunacy that we're living in right now, the mass delusion. $7 trillion is more than the entire budget of this country. But one must ask a question here. Where did this guy come from anyways? He popped out of the blue. Why do we see these characters implanted in the business cycle? Who's behind it really? Because these tech entrepreneurs, they pop out of nowhere. They become idols. Folks worship them. They become filthy rich, and then years later, you find out what their true intentions are. And it's usually political or changing society or the climate. You know the deal. A great question would be, where did this guy come from? And who's really behind him? But again, a great illustration of the bubble that we're in, the greatest one of them all, and the last one, when things get out of whack. And you will notice, I will show you in this program, that whatever we're seeing right now is nothing new. It is exactly the same way it happened before the blow-up of every bubble that we've seen before. History repeats, but only few remember. What we see right now is perhaps the most over-concentrated rally in history, even surpassing the dot-com mania. Technology is now over 1/3 of the entirety of the United States stock market. The S&P 500 is now a technology ETF. It lives and it dies with technology. Do you realize how dangerous this is? When the entirety of the stock market is reliant on a handful of companies that are too big to fail? More examples of the extremes that we have. The S&P 500 has been running for weeks now, 15 weeks with no corrections. The highest since the 1970s. The S&P has been trading for 70 trading days with no 2% pullback. The garden variety that we get in normal and healthy bull markets. The sentiment is out of whack. Asset managers are the most long U.S. equity futures in at least the last 15 years. Everybody's all in the same handful of technology stocks. You look at the returns of the S&P 500 without the so-called Magnificent Seven since 2022, and the returns are less than 10%. The returns are negative since 21. But then you plug in the Magnificent Seven, where the bubble is concentrated right now. All of a sudden, the S&P 500 is doing great. What is the problem with that? When the entirety of the stock market is reliant on 7, now really 5 stocks. You see, so far this year, we lost Tesla, and it appears that we're losing Apple. They're not contributing positively to the returns of the S&P 500. And soon enough, we're going to lose more and more. Of course, Nvidia is the poster boy of the bubble right now. It will pop. Once it pops, the bubble ends, the stock market will crash, and you will never see the highs for decades to come. Why do we say that with such confidence? Even though we're accused of being wrong because the stock keeps going higher. Who cares? It's a bubble. The real question is, how does it end? We know it's going to end badly because every bubble acts and reacts the same way. It begins and it ends the same way. And this one is no different. The only difference is the scale of the rise and the scale of the crash, which is the biggest of all time. And that should be terrifying for folks, not a source of excitement and euphoria. With that out of the way, let's dive right into it. And here it is. In focus tonight. The grand finale. This is the last one of the series of bubbles that began from the great liquidity bubble in 2020. It will bust. Once it does, game over. We will mark the highs. You will not see these highs in these individual stocks for decades to come, which will lead the stock market to be in a lost decade. And you know what sparked the idea behind this video? It's a question from the viewer here. Says, Mav, please compare Cisco in 99 to NVIDIA. Is it possible that NVIDIA will reach 1,000? The short answer is in a bubble, yes, it can reach 1,000, 2,000, doesn't matter. Question is, how will it end? And what can we learn from the dot-com bubble? There are differences and there are similarities. And I thought it was a subject that is worth exploring. The recent action that we've seen in NVIDIA and many other stocks, specifically really large cap stocks, brought back memories of 1999, the famous Y2K rally. And the headline from MarketWatch reads, the stock market right now resembles the Y2K surge, and that did not end well. But of course, I know that there are critics of this comparison, that you can't really compare what we have right now with 1999. It's different this time. For example, the headline for Business Insider reads, tech stocks' huge gains should not make investors fear dot-com bubble 2.0. Gee, why would they say that? Here it is. They argue that we have key differences between now, the bubble that we have right now, and 1999, like the profitability of mega cap tech firms. It's different from 99. I watched a conversation in CNBC that also discussed why we should not compare what's going on today with 1999. Take a look.
Well, it's really more exuberance, and the question is it rational or irrational? I was saying that the alternatives to the roaring 2020s is something like the 1990s, where we get irrational exuberance and things move too quickly. And there are similarities in what we're seeing here in terms of the concentration in tech. But remember, back in the late 1990s, a lot of tech really didn't have earnings. And not only that, but a lot of tech was rigging their sales with seller financing. It's particularly in the telecommunications area. This time around, the earnings are real. These companies that are doing well don't depend very much on debt. And they've got what it takes to deliver for investors.
Hey, Ed, it's Josh. Good to see you. I was going to say, there are a lot of signs that we're not at euphoria, at least not yet. For starters, Americans put $1 trillion into money market funds last year. Correct. Most of that, if not none of that, has come out yet. That's not euphoria. How many IPOs did we have last year? 4? Yeah, 7? I feel like I can count them. That's not quite euphoria. No IPOs this year yet either, worth speaking of. Those are two of the things just off the top of my head that you would say would be very inconsistent with this idea that it's 1999. And to your point, I was around, Michael Santoli was around. We saw the types of deals that were coming out. Forget about earnings. They didn't have revenues. They were worse than the 2021 SPAC vintage. So this is not that. We might get there if this keeps up. We haven't gotten there yet.
Now, there are two fallacies with this argument. Sure, in 1999, and even before that, we have seen a slew of garbage IPOs, worthless .com bubbles with not even revenue, but the valuations went out of whack. They say, oh, this time it is different because we see the bubble in really profitable and large companies, not in speculative IPO names. What they miss, and it is fallacy number one, that this bubble that we have right now is not idiosyncratic. It is connected. It is the last episode of the greater bubble that began in 2020 with the tsunami of liquidity in response to the pandemic. We have already seen the IPO mania come and go. You see, the tsunami of liquidity that began in 2020 created a series of bubbles. These bubbles are being popped one at a time. Economist Ed Yardeni, who we featured in the intro of this video, and by the way, one of the biggest bullshitters of all time, he argues that we have already seen a rolling recession, and now we're about to see a rolling recovery, and we will see the roaring 20s again. I argue that we are seeing the rolling crash. The IPO bubble already came and crashed. Now we're dealing with the last bit of that greater bubble, which is the bubble that is concentrated in the large caps, the mega cap technology stacks, the semiconductors, aka the AI mania. The AI mania is an episode, the final one, in a larger, greater bubble series that began in 2020. Look, for example, at the IPO ETF. We've already seen the mania in IPOs, and they came down crashing in the year 21. Names like Coinbase, for example, used to trade at above $440 a share, and it went down crashing. Names like Revvion used to trade at almost $200 a share, also crashed. The bubble was popped here. We also got a vaccine bubble. Names like Moderna, that bubble also popped. We got the retail investors bubble already in names like RKK, ARK Invest. That bubble came and now it's gone. It popped. It's over. We have seen the stay-at-home bubble during the pandemic. Names such as Etsy, and that bubble already popped. Names like Peloton, also the rise and fall, you can see it right in front of you here. Names like Carvana, during the pandemic, the mania of buying cars online, then it came down crashing. That bubble is already gone. Zoom, the biggest one of them all. We've seen the rise and fall of Zoom already. That bubble already popped. Now, the second fallacy of what you just heard from CNBC is, oh, now we have profitable companies, so you can't say that this is a speculative orgy as we've seen in 99. Well, need I remind you that in 99, the bubble was actually led by really profitable companies, names like Cisco and Qualcomm and Microsoft. But all bubbles act and react the same way. All bubbles rise and fall the same way, regardless of the scale and regardless of the growth and profitability. Believe it or not, bubbles are not divorced from fundamentals. Bubbles are actually born because of fundamental reasons. We see expansion in the margins of a certain company, and that's why we see hyper growth in the stock price. But if the conditions that led to the expansion of the margins of a company or particular companies within the stock market, if the reason behind that expansion is transitory, then it is a bubble. And once that reason is passed, we see the collapse of that bubble. It is no different. All bubbles act and react the same way. They have a reason that spikes the profitability of these particular companies, and then we realized that those reasons were transitory, and now we have reached a peak of that story. And then comes the crash of these stocks. Take, for example, the story of Zoom. I don't know if you remember, but Zoom at one point surged by 40% in a single day, which what we saw this week with names like ARM, and what we've been seeing since the beginning of the year, and names like NVIDIA. Take a look.
We start off with Zoom. Whiz, pop, bang. However you slice it, Zoom's shares staged a gigantic rally after posting a blowout earnings quarter. Its 40% jump today now gives it a market cap bigger than Lowe's, UPS, IBM, and Citigroup, and it is about 3/4 the size of Cisco, which of course is a similar product, and 83 times the revenue. So what do you make of this giant move today? Pete, what do you say?
Well, it's pretty incredible, Mel. I don't know how often we've been able to see a stock that's actually jumped by 40% in a single day, but it ran into earnings. We've seen nothing but bullish paper in here for the entire year of 2020. They've been buying and expecting movement to the upside, and it's been delivering. And the interesting thing, I think, Mel, is when you look at the numbers, yes, the numbers were astounding. When you look at the revenue numbers and the earnings beat and all the rest of those things, it's incredible. But I think what stands out for me is that I look at this company and you just wonder, there's not a short squeeze going on here. Oftentimes we see stocks like this make these kind of moves, and a lot of that might be a short squeeze. That's not the case here. It's not a very large short position. So I think this is just an amazing stock that has continued, and people look at this stock and they think to themselves, is this stock going to be around after the pandemic? And I think so far people are thinking yes, and it is a verb. So I think for all those reasons, this is a stock that people better be careful of, because I don't think you want to short this name still.
Yeah, to Pete's point, the short interest, according to FactSet, is just over 5%. Dan, this is an amazing company. Yes, the CFO on the call, though, did say that the sequential revenue growth would be down third quarter, fourth quarter, and yet analysts are saying that is just too conservative. It is amazing what the analyst community and investors are looking to look past at this point, even with this giant run.
And I hope you caught it there, the last commentary, which is, the management said that sequentially they're going to see a drop in the growth in revenue and profits. That was the key right there and then to realize that the bubble is over. But the coked up analysts and the investors, they think it's going to last forever because Zoom is the future. They don't realize that, yes, the bubble was based on fundamentals, the expansion of the profits of the company. That's real. That's not fake. But that was transitory because everybody was staying at home. When we go out and about, the profitability of the company will decline, and hence the rise and the fall of the bubble. So if you want to know when this bubble is going to pop, you have to keep your ears open to the commentary by management about sequential guidelines. If they guide down quarter over quarter, despite what the analysts say, that is the leading indicator that the bubble is about to pop. And the stock market, ladies and gentlemen, is all about the margins. Here's Zoom. Look at the net income. In the year 2020, it blasted higher to over $670 million. The prior year, the company made almost $22 million in profits. Huge spike year on year, almost worth 3,000%. Then in 21, the profitability of the company reached almost $1.4 billion, only to drop by more than 92% in the year 22 to only $1.3 million. And of course, the stock topped and began to crash in 21, which is the peak of expansion in margins. Why? Because there are folks who are sophisticated, who ride these bubbles, but then when they hear anything about a peak in growth in margins, they begin to dump. So even though in the year 21, we have seen expansion in net income for Zoom, that was the top in the crash year because the stock market looks forward. When it did, it's so that the margins have peaked here in this company. And now we're going to go back to normalization. It doesn't say that Zoom is a bad company or not. It's actually a good company. But again, that expansion of the margins of the company was transitory. There were reasons that led to that expansion. Then we've seen normalization and the bubble went poof, gone. Another example, the vaccine bubble in Moderna. And by the way, folks, in this channel, we talked negatively about Zoom and Moderna and Y2K back then in 2020 and 21. We were accused of being boomers and you don't understand, this is the future. We did not care. We knew what we were doing in this channel. We were confident. And we shorted when the time was right, and we booked the profits from the rise and fall of these stocks. Those who chased the bubbles, not sure that all of them walked away with profits. But the point being here is that bubbles are not really that divorced from fundamentals. The expansion in the multiples of a certain stock is based on the expansion of the profits. The question now becomes, is the expansion in profits transitory due to a bubble or not? And you know that when you see outlandish expansion in margins year on year. Usually that's not sustainable, and it is an indicator that we are in a bubble indeed. So you look at the net income for Moderna. Company was not profitable before the pandemic. Then came the year 2021, and the company made net profit of over $12 billion. The stock rallied in a bubble before we got that number, in anticipation of that number. And then it began to crash in 21 in anticipation of what? The drop in profitability. It went down from 12 billion to 8 billion. And it appears that in the year 23, Moderna will go back to losing money. Matter of fact, losing over $3.5 billion. So that's the story right there. The bubble came and it went. Now we'll look at NVIDIA. In a regular year, the company produces net income of, let's say, $3 to $5 billion. We have seen a temporary expansion of those margins in 21 because of the crypto mania. So we've seen demand on NVIDIA's chips, and the stock went higher, expanding the multiples because its net profit jumped from about $4.33 billion to almost $10 billion in the year 21. But then, in the year 22, we've seen normalization of net profit. It went down to about $4 billion. So we've seen the stock of NVIDIA peaking in 21, then crashing down in the year 22 because it was a reflection of what the company is going to produce in profits by the end of the year. Now, in the year 23, we've seen a recovery in the stock, and we've seen the bubble. Thank you to the AI mania, it appears, at least for now, we haven't gotten the final report for 23 by the company, but it appears that the profitability of the company will jump to almost, let's say, $19 to $20 billion, which is the highest profit in the company's history, almost double what the company produced in the year 21. So when we see the expansion of the multiple of the stock and the price of the stock, is it really irrational, or is it a reflection of the expansion of profits? Of course, the bubble begins as a fundamental bubble, but then at the last bit of it, it becomes a speculative orgy when everybody jumps in, FOMO, etc. And that's usually the leading signs that the bubble is about to go bust. So in the question of NVIDIA here, the bulls would say, no, this expansion in profits, you'll see that's going to continue for next year and the year after that. And this is why the valuation of the stock right now is reasonable, and the stock is not in a bubble. But again, based on the experience and the analysis that we do and what we've seen in past bubbles, when you see a huge leap in profitability, usually that's not sustainable. We've never seen it sustainable because the huge leap in profitability is indicative of transitory reasons that will fade away. Then we will see normalization in the company's profits. It will still be a great company, really profitable, producing a lot of growth, but it's not going to be a company that produces $30 billion in profits a year. And that's how the bubble rises and then goes bust. So all of this talk about, 99 was a speculative orgy, you can't compare it with today, that's a fallacy. Look at the larger stocks that led the bubble in 99. They were handsomely profitable in a big way, just like we see with NVIDIA right now. The poster boy, of course, is Cisco. So you see the massive rise in the stock. Then it came down crashing when the bubble ended. Gee, was it just a speculative orgy with no fundamentals at all? Of course not. In the year 99, we have seen huge expansion in net sales for Cisco, in profitability, in earnings per share. So there was a fundamental reason behind the expansion of the company's multiples. Now, whether the degree of the expansion was rational or not, I think you know the answer to that. I think you know the answer to what's going on with NVIDIA right now. Then we go to the year 2000. That's when the bubble popped. That was the top in Cisco, but again, that year, net sales exploded higher. The net income, the profitability of the company exploded higher. Yet the stock topped anyways and came down crashing. Why? It's so what's about to come. That this is the top, this is the peak, this is as good as it's going to get. But we cannot justify the multiple where the stock is trading at right now based on what we see in the future, which is the peak of expansion in this company, specifically when it comes to the margins. We'll look at the year 2001. You can see that revenues expanded in Cisco year on year, but net income went down negative because when you have bubbles like this, at some point the company has to spend more to sustain its status. And while we see growth going higher, we usually see the profitability coming down, and that's what usually ends these bubbles. Then in the year 2002, the company became profitable again, not as or used to be in the year 2000, the peak. And of course, it grew, but the growth went negative year on year. So the stock reaction in crashing was right, that we've seen the peak of the bubble, and now we can no longer irrationally expand the multiple of this company. We need to go back to rationale, that the hyper-growth period of this stock is over. It was based on transitory reasons. These reasons came and went, and with it the bubble. And here's the stock of Cisco decades later. We're not at the highs yet. Almost a quarter of a century later. We've never recovered the highs because expectations went out of whack when the stock surged to those highs. Is the internet still with us? Yes. Did the internet change the world? Of course. Is Cisco still a great company? Absolutely. It's producing almost, $58 billion worth of revenues a year? But all bubbles act and react the same way. We get into a period of huge expansion in margins. We see excitement by the retail investors, by the institutionals. The narrative gets out of whack, and we see the multiples expanding significantly higher with the assumption that this hyper growth will continue. Then we find out that it's not going to continue. It's not realistic. And that brings the end of the bubble. Another poster boy of 1999 and the dot-com mania is Qualcomm. You look at the chart of Qualcomm. It exploded higher. Never recovered the highs until about 20 years later. But was the expansion of the valuation of Qualcomm lacking any fundamentals? As the folks on CNBC say that, oh, this is different because now we have fundamentals. 99, we did not have fundamentals. Absolutely not. It's bullshit. Here's the report from Qualcomm 1999. The net income, the margin of the company exploded by over 241% year on year. Hyper growth. And investors were looking for hyper growth. And they went bananas, expanding the valuation of the company based on this hyper growth, assuming that it is going to be sustainable and long-lasting. It's here to stay. It did not. Does it mean that Qualcomm is not a great company? It's here. It's in every phone right now. It's way bigger than it was back in 99. But bubbles take things out of whack. That's the nature of bubbles. The headline from the LA Times, April 14, 2000. Black Friday, if you remember, with the NASDAQ crashed by almost 10%. The headline reads, strong tech earnings don't hold markets decline. What is the lesson here? It will get to a point where you see NVIDIA producing a really decent report, but the stock goes down anyways, and we see the stock market beginning to crash. And folks will be baffled. What's going on here? It's a great company. It's producing really decent profits and revenues and growth. And what about AI? It's here to stay. But the market sees peak expansion in net income. The big guys, the big shareholders begin to unload. And the bubble begins to crash. And of course, the retail investors and the analysts, the pimps on TV, they come out and say, no, the dip is here to be bought. So for everybody who says, oh, you're missing out on the bubble, Maverick, why not just ride the bubble? Can you time your exit? Of course you can't. I can't. I participated in bubbles before. I'm just not good at them. I'm not good at pulling out. Even though I don't have any children, so maybe I'm good at pulling out. At least I don't have children that I'm aware of. But anyways, maybe you are good at pulling out. Maybe you can time it. You can ride the bubble and then get out when you see the sequential change in guidance. And you can short it after that. You can ride the bubble up and down. But there's only one Mark Cuban here, folks. Most investors who ride the bubble, they lose money at the end because it becomes an emotional attachment. The stock made you a lot of money on paper. Now it dips down. You're not going to let go of it. You're not going to say, oh, it's over now. It's time to dump and short. You're not going to say that. You're going to continue to buy, watch the stock go down, the rise and fall. And what I've learned throughout the years is I'm better off not participating in these bubbles. I'm better off waiting till they top, then short them and take them on the way down. Because when I short them, at some point I have to book my profits. And I've done that successfully, of course, in the last round of bubbles. The IPOs, the retail mania, the Pelotons, the Zooms, the Modernas, and all of this is documented in this channel. We'll talk about that in a minute here, but it's just my style, folks. If you can time it, you can ride the bubble and have your emotions intact that this is a bubble, and you get out in time and short it in time, more power to you. But looking at the psychology of most people, they can't because they'll see stuff like this. Oh, but the earnings are good. Why is the stock going down? I'm buying more. Anyways, we'll revisit this psychology later on. The headline from 2000, the Wall Street Journal reads, arrogance, greed, optimism fueled the internet bubble. Sounds familiar? And since NVIDIA is the poster boy of the last bubble that began in the year 2020, the liquidity bubble. If NVIDIA goes down, it's going to take everything down with it. So when will NVIDIA go down? Now that you have some understanding about history and Cisco and Qualcomm and all of that, let's see what's going to happen in NVIDIA here. We have volume of sales, the price, and the cost, and the calculation of all of these things give you a margin. The stock market at the end of the day cares about margins. If they go higher, stocks go higher. The margins go down, stocks go down. Suppose these were the conditions of NVIDIA before 23. Then we got the AI mania. All of a sudden we have large companies stampeding to develop their AI capabilities because now investors are putting a higher price on AI. They can't do without NVIDIA's advanced chips, which NVIDIA, by the way, had these chips since 22. It was already in the inventory. The pricing was reasonable. But now that we have a stampede by large companies to buy these chips, the volume, the demand spikes higher. But since we have limited supply of these chips, the pricing also goes out of whack. They sold these chips at 40 grand a piece. Meanwhile, their cost is down because they're just selling existing inventory. Lucky for them, we've seen the AI mania increasing demand with lack of supply. Pricing goes higher. The combination of all of these things makes margins explode higher. With it, NVIDIA stock also exploded higher. What usually happens after that, and we've seen that with Cisco, to maintain this demand, to serve this demand, now NVIDIA is going to run out of inventory. They need to manufacture more. But now the companies that manufacture the chips for them, they will demand more too. So what we've seen so far from semiconductor earnings, companies like Taiwan, for example, all of a sudden we see the numbers for that company surging higher. Companies like Applied Materials, which we're going to get a report from this week, they're also saying, just like ASML, that, hey, we're seeing demand going higher here for future orders. Well, gee, who's doing the ordering here? It's NVIDIA. NVIDIA is now spending more to produce these chips to meet the increased demand that they see from their own customers. Well, when the cost goes higher, what happens to the margins? You still got the pricing power, you still got decent volume that is increasing, but the margins go down. So maybe we're getting really close to peak margins in this company. And then what happens? As the AI mania begins to develop and mature, we see more players now who want to cash in the gold rush. Companies like AMD and many others now developing AI chips too. When the supply increases, you can see an expansion of volume. The demand is still healthy for these AI chips, but the pricing power is now lost because we have more supply. So cost goes higher, pricing power goes down while volume goes higher. What is that going to do to the margins? The margins begin to go down. So we've seen peak margins and now they begin to trend down. Little by little, we see exogenous events in the economy. Interest rates, recession, consumer demand goes down. This feedback now reaches these big companies who are buying the chips from NVIDIA. They begin to see that their numbers are going down because of the weakness of the economy. So they stop. They pull back from ordering these chips. What happens? The volume goes down. With the volume going down, pricing power also goes down. Now you got more supply than demand, while your cost takes a little while to take it down. What does that do? The margins get absolutely horrible. And that's probably the bottom in the stack. The bubble crashes and we see the bottom of the stack here because why? Sure, volume goes down, pricing power goes down, but also the cost goes down. At some point, we see margins normalizing again. And at some point later on, the demand increases for these chips again, but at a reasonable price. And the cost becomes more reasonable, and we see normalization in margins. They grow, but not at a hyper-growth scale that we've seen in the year 23 and possibly 24. So you look at the chart of NVIDIA right here, weekly chart. It is absolutely bananas, but it will end the same way as Cisco, as Qualcomm, because all bubbles act and react the same way. It is a story of hyper-growth in margins that comes and it goes, and the stock will spot that ahead of time. So if you get a report from NVIDIA and you hear management saying, oh, but you know, next quarter, the revenues will grow at a lower pace. Profits will grow at a lower pace because cost will go higher. Understand that, okay, we got the top. And this is the beginning of the crash of the bubble. The company will still do fine. Their numbers will still be pretty good, but the stock is not going to perform that way. Furthermore, a lot of folks ask me, have we seen anything like this before? It feels crazy. It's out of whack. It's insanity. It's never going to stop. The Biden administration is manipulating the stock market. The Fed is doing this and that. Look, frustration is one thing, but I just showed you that bubbles have fundamentals to back them. But these fundamentals are transitory. Keep your eye on the ball, not the noise and the emotions. Have we seen this before? Absolutely. It's exactly the same thing that happens in every bubble. And it's exactly the same thing that happens before every crash. The concentration that we see in the stock market right now is nothing new. We see the economy weakening and the Fed raising rates. Folks migrate and concentrate in a handful of names, usually technology stocks, because they still have growth. The feedback of the weakness of the economy reaches these companies later. Most of these technology companies do B2B, not B2C. They do business to business, not business to consumer. Business to consumer companies feel the weakness first. The feedback reaches B2B later on. So when we look at the gap of performance here between the Magnificent Seven, really five now, because Tesla is a B2C, Apple is B2C. Microsoft is B2B, so is Meta, so is Google, so is Amazon, kinda, AWS, and of course NVIDIA. But this kind of concentration, we've seen it before, and it is a sign that the bubble, this is the last episode of the bubble, and we're gonna crash after that. What have we seen in the year 23? The NASDAQ leading the pack, and the S&P, of course, because it's now heavyweight with technology. But the Russell 2000 small caps lagging. Now, if you want to assess whether we are in a bull market or a bubble, you always look at the small caps. Small caps lead the beginning of bull markets. But the end of the cycle, before a crash, is always led by concentration in the technology names, while we see small caps actually end up performing. 2007, the Russell 2000 was down 2%, but the Nasdaq was up almost 11% for that year. We all know what happened in the year 2008. Here's an illustration for you. The RTY, the Russell 2000, was down almost 5%. If you look at beginning of 2007, let's say to the beginning of 2008, the SPX was up about 2%, but the Nasdaq was up over 14% in that period. NVIDIA at that time was a much smaller company, but again, it was up almost 37%. Google was up almost 42%. Apple in 2007 was up almost over 120%. Research in Motion, aka BlackBerry, was the equivalent of NVIDIA today. That stock was up almost over 140%. Amazon up more than 140%. You see the concentration of gains in the technology sector, but small caps lagging. Gee, when did we see that before? 2007. How about 1999? The headline from the LA Times reads, 1999 goes into the record book on Wall Street. I'm going to read snippets from this article right here and notice the similarity, because the arguments that we hear today, oh, you can't say it's a bubble when you have the Italian stock market, the Indian stock market, the German and Japanese stock markets, also moving higher. Listen carefully here. But investors worldwide had basically been saying as much for months. The spectacular 1999 gains in equity markets from New York to Athens to Singapore were a strong vote not only for a smooth transition to the new millennium, but also for a booming global economy in the new year. Technology stocks, of course, were the driving force in the U.S. market in '99. Ravenous demand by large and small investors alike for shares of semiconductor, software, internet, and telecommunication issues drove the Nasdaq Composite Index up 85.6% for the year, the greatest calendar year advance of any major stock index in U.S. history. In a short trading session on Friday, while both the Nasdaq Index and the Dow ended at new highs, the 28-year-old Nasdaq again showed the 103-year-old Dow who's in charge now. Nasdaq jumped 32.44 points, or 0.8%, to 4,069.31, while the Dow rose half as much in percentage terms, adding about 44.26 points to 11,497.12. Still, the blue chip Dow's 1999 advance of 25.2% beat the broader S&P 500 index gains of 19.5%, thanks in part to the Dow Jones decision to take a page out of the Nasdaq's book and add tech giants like Intel and Microsoft to the 30 stock index on November 1st. Microsoft has since zoomed 26%. Intel has risen 8%. Here's an important part. On Friday, the Russell 2000 jumped 106% to a new high of 504.75. Listen to this. Some traders said that suggested bargain hunters were snapping up depressed smaller stocks, hoping for, quote, January effect, end quote, bounce, a surge in shares that had been beaten down at year-end by tax-related selling. But that kind of bargain hunting would have to be dramatic to bring many U.S. stocks into the bull market that tech stocks have enjoyed over the last year. In particular, here's the most important part, folks. Pay attention now. Indeed, a question raised over and over on Wall Street in '99 was, whose bull market is this anyway? Question mark. On NASDAQ, for example, nearly half of the market's 5,000-some stocks actually declined in price in '99, even as the NASDAQ Composite Index zoomed. A major problem for many stocks, though, obviously not the tech sector, was ongoing rise in interest rates. The Federal Reserve raised short-term rates 3 times during the year, citing concerns that the U.S. economy's tremendous growth rate might boost inflationary pressures. That made for sheer misery in the bond market. Bond values plummeted as yields on the bellwether 30-year Treasury bond soared, closing 1999 at 6.48%, the highest since late 1997. And up 5.09% at the end of 1998. On total return basis, counting interest earned, then subtracting the net loss in principal value, the Vanguard long-term Treasury bond mutual fund lost 8.1% for the year. With the heated action in many tech issues worldwide over the last 2 months, analysts have run out of superlatives to describe the phenomenon. Pay attention again. The cult stocks of the end of one millennium and the beginning of another include wireless technology titan Qualcomm in the United States, consumer electronics giant Sony in Japan, cellular phone leader Nokia in Finland, and internet content company China.com in Hong Kong. The market's bulls say there's a fundamental basis for these stocks gains. Technology is the future, after all, and many of these companies unquestionably boast the best growth prospects of any business on earth. The market's bears say this is like any other investment mania in history, only worse. It can only end in a crash of stock values, they say, at least for the tech sector, and possibly for the broader market. We know who won this argument at the end. And again, you notice the similarity. Concentration in the rally. Tech is the future, but earnings are good. But we see all of these other corners of the stock market underperforming. These are all warning signs that we are near the end, not the beginning of a new bull market. And this is why you might have heard the old timer at the end of the intro. Right? Let the young guys speculate, we wait till the end, and then we cash it all out. By the way, that guy, unfortunately, he capitulated and he said maybe the young guys are right this time around. And then he lost all of his money. I think he died shortly thereafter. But anyways, the boomers, the old guys, they're saying thank you to the young guys who are chasing the mania right now. Please, keep it going here. We're going to retire at the best conditions ever. So we see excess retirees exploding. Thank you to the stock market mania. The boomers will cash out. Who's going to hold the bag? I think you know the answer. You see actual retirement spiking higher. The boomers are not stupid. They've seen it before. They know what's going on here. So they're cashing out. Thank you so much. Question is, will the younger guys realize what's going on here or assume, oh, it's technology, it's the future? You don't understand, right? The S&P 500 cannot mask the chaos beneath the stock market's calm. We just showed you. It's not even Mag 7 anymore. It's Mag 5. Now maybe you're seeing some broadening of the rally in semiconductors because NVIDIA is spending more. So you see Taiwan, you see ASML, AMAT, all of these companies now also gaining some momentum. And if you're a momentum trader, you're probably chasing those kind of names. You're switching from NVIDIA to Taiwan, for example. There are 7 million ways to benefit from bubbles. There are those who chase them, stop at the top, and then they short. Those are a rare breed. That's Mark Cuban. There's only one Mark Cuban. There are folks like me who love to short them at the end. There are folks who love to chase them, but most of them can't really get out of the top. Others, they switch from name to name based on the evolution of the bubble. And again, this bubble is supported by fundamentals. The Biden administration is now announcing $5 billion commitment for semiconductor companies. Companies making record profits, by the way. We're giving them handouts to build factories, courtesy of the taxpayer money. But all of this irrelevant to the bubble that we have. And folks will be baffled, but the earnings are good. The administration is spending. Why is the stock going down? You know why. The hypergrowth in margins would not be repeated. Now, does that mean that you go ahead and short everything right now? Short NVIDIA right now? You can trade via put options. You can take a shot. You know exactly what you're going to lose. If you do put options, I've done few put options trades against NVIDIA last year. Most of them lost. One of them hit big in October, but that's about it. But shorting them, I'll show you when. In the meantime, for folks who say, oh, you've been bearish on NVIDIA, you've been wrong, I'm not going to be wrong. The stock is going to crash. You saw what happened in the past. I just explained all of this for you. The question is, how high will it go before it marks the top? For now, you trade the technicals. And before this latest breakout in the stock NVIDIA, for all of the folks who criticize me, repeatedly, I've been saying the stock looks good here from a technical basis. The stock is going to break out. All of the energy from the consolidation will go higher. That's documented in this channel, folks. Take a look. We look at the Vortex indicator. You see the red line going down, the blue line is about to cross. That's called a bullish crossing. I look at my support line, 467, we're above. I look at the 20 days moving average, we're above. So again, you might hate NVIDIA. Nobody hates NVIDIA more than me. But the chart right now, leaning more bullish than bearish. All of the indicators saying, if we close like this, you probably want to hold your nose and buy some calls here. If we look at the weekly chart here, what do we see? We went to the lower Bollinger Bands, caught support. Went all the way to the upper Bollinger Bands, couldn't make it. We went down on a retest to the 20 weeks moving average, and now we're rebounding and moving higher again. And the risk is A, B, C breakout. That takes us all the way back to all-time highs. You gotta keep that risk in mind here, folks. I'm certainly not the biggest fan of NVIDIA, but the risk here is clear. So if you see it, you agree with it, you gotta hold your nose here and play some short-term, at least, upside momentum here in NVIDIA. Then we have NVIDIA at a weekly chart. What do we see here? Opposite of Tesla. At least in the weekly chart. Above the 20 weeks moving average, check mark. The RSI is improving, check mark. The MACD is about to give us a cross, changing bearish momentum into bullish momentum, check mark. Vortex indicator, look at the blue line. It is moving higher, above the bearish line in red. All the indicators in the weekly chart of NVIDIA saying higher we go, until proven otherwise. And of course, the daily chart would be a leading indicator. If we lose the 20 days moving average, then you're going to see that instead of improving from bearish to bullish in the weekly chart, we're actually dipping down more into bearish. But for now, as it looks right now, the risk is for NVIDIA to break above this pattern and challenge the upper Bollinger Bands in the weekly chart and then expand them higher, move above 500. That's the risk for now. Now, as the stock went higher, did I become less bearish on NVIDIA? Of course not. I became more bearish because the crash will be bigger. I'm just waiting for these names to top and then I'll hit them. Just like I hit RKK, Zoom, Moderna, Carvana, and the rest of them. They will end the same way. When do you change your mind and you become bullish again? Well, if you show me that the expansion in net income is sustainable to the same scale, 200, 300% a year, that's going to be sustainable for years to come. You can't make that argument because if you know anything about the law of large numbers, you know that's not possible. Furthermore, as you've seen in the intro and the explanation that I just did for you, at some point the fundamentals of the economy catches up with the stock market. That always happens. So I'll change my mind if the data changes. Think about it this way. What is the point of me being bearish? You think that's cool? You think that's going to make you money? Of course not. I'll have a lot of job offers and thousands more members in this channel had I talk bullish in this bubble right now. So why would I put myself at disadvantage for clicks and baits? I only put one public video per week since the year 23. I don't give a shit if this video gets 10,000 views or 100,000 views. Am I going to compromise for clicks and baits to make what, $200 a video? Why? Why would I take a stance that hurts me financially and hurts this channel financially? It makes a lot of members, a lot of viewers say, oh, you're wrong. The market keeps going higher. I'm missing out. Goodbye. It's because my analysis leads me now more than ever toward a bearish conclusion. What do you want me to do? Sugarcoat it for you? Give you a picture that I don't really agree with just to go with the flow? I'm not going to do that. Show me how the fundamentals in the economy change from what I see right now to positive. I'll tell you, okay, you're right. I'll switch to bullish. I got no problem with that. It's not an ego battle here. Look at what's going on in the actual economy. Excess savings from the pandemic are now being eroded. Consumer purchasing power is going down and will continue to dwindle here as inflation takes a toll. And of course, you see what's going on. Excess savings go down. Inflation is still here. The rate of inflation is slowing down, but prices never went down. Wages, they go higher for certain workers. You get a raise once a year, but you're still lagging the rate of inflation. So what do? You use credit cards. And we see that credit card delinquencies are now rising for the consumer. 8.5% right now for credit cards, 7.7% for auto loans. Not as high as the GFC, but we're heading there. And given the amount of debt that we have right now, 8.5% is probably worse than double digits back in the GFC. The company PepsiCo came out this week. They said, folks, we lost the pricing power. The volume of sales is going down. Consumer cannot buy as much as they used to. We're raising prices to counter that. Now the consumer is becoming price sensitive. They can't spend like they used to before. What is that going to do to the company's margins? It goes down. Not to mention the layoffs that we see all over the place. Forget the fake government data. Workers' confidence, that's what's really important. Their confidence whether they're going to keep their jobs or not, whether they can find a job or not if they get fired, because that influences their spending behavior. The share of employees positive about 6-month outlook at their employer is plummeting as we speak right now. Not a good sign for the economy. When you look at the wage growth tracker at the Atlanta Fed, year on year, wages are negative. That's recessionary. All of this will add pressure on consumer spending. And the consumer is the backbone of the economy. The consumer is the backbone of corporate fundamentals. Well, we see all of this pressure will reduce. Maybe we've peaked in consumer spending right now. Corporate bankruptcies at 13-year peak. And folks say, oh, but the Fed is going to cut rates. That's going to fix it all. No, the Fed is not going to cut rates. The Fed will cut rates if they see a disaster in the economy. It will be a reaction to something bad. And when you see rate cuts, that's probably bad for the stock market. The best period for the stock market in any cycle is the pause period, the peak of rate hikes until the beginning of the cut. You begin the cut, it's because the shit hits the fan. So again, for all the critics, I'm happy to turn bullish. Just show me how all of these fundamentals of the economy will change to positive again. In the meantime, like I've done before, and we're not talking 99 here, we're talking about a couple of years ago, the beginning of this bubble. We talked negatively about Cathie Wood and RKK multiple times. We warned about the crypto bubble. We warned about Zoom, Peloton, Moderna. We were criticized as, oh, you're a boomer, you're doom and gloom, you don't understand, embrace the future, yada, 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 as these stocks were going higher. At the end of the day, when the time was right, I shorted them, they crashed down, I pocketed the profits, and those critics, Did they keep their profits from the mania? Most of them did not. And the same thing will happen here, only at a larger scale. You look at Y2K, that one crashed. We talked about Zoom. Go look at the comments on these videos. Boomer, doom and gloom, but it happened. Zoom crashed just like Cisco. All bubbles, regardless of the scale, act and react the same way. This one is huge. The sheer scale. It shouldn't make you feel more confident that it will defy the bubble rules and principles. It should make you more terrified that when it comes down, it will take everything down with it, because these names are too big to fail. They're not Zoom. It crashes down, it hurts few investors, but the economy and everybody does fine. If these names, the Apples, the Microsofts, and Nvidias, if they go down, they're taking everything down with them. And that should be terrifying to everybody. Okay, now comes the question. How do you know when to short? Like I said, you can play put options all you want, but short, when you borrow millions of dollars and you short the stock and it begins to crash, then you buy it back and you pocket the difference. Usually, again, since bubbles act and react the same way, usually we see a last hurrah rally that defies the logic, baffles everybody, goes way out of whack. Then we see a shock. Usually the shock isn't because of the company's fundamentals. You might see the sequential warnings though, but we see the shock for an exogenous reason. CPI, Federal Reserve policy, a foreign economy going down. In the case of 99, it was Japan. I would say this time around, keep an eye on the UK economy. That is the weakest link here. But we see a big flush down. And then we see a recovery. And the bulls say, we're so back. The bears are wrong. I'm not selling here, even though it is the top. This is the end. This is why bulls lose money chasing bubbles, because they don't know when to get out. Every dip was bought. We've seen V-shaped recovery after V-shaped recovery, so we're now accustomed that everything comes back. The Fed will fix it all, and that's when they get entrapped. Likewise, when that happens, what is the psychology of bears who've been picking up on the bubble as it went higher? They will say, this insanity will never end. It'll go back to the highs again. Leave it alone. That's when you know it's over. So psychology is really important here in the success of being long the bubble and short it. In the meantime, I'm happy using my Buffett strategy. I have a long portfolio. I'll buy stocks with good valuations, decent growth, that are not in a bubble really. Back in the dot-com, Warren Buffett was criticized as an old man. He did not embrace technology. He missed out. Headline reads, Buffett hits a bumpy road. Berkshire Hathaway near 52-week low. You think Warren Buffett gave a shit about any of that? Of course not. He didn't care. He stuck to the fundamentals and his style of investing, not what the crowd thinks. Sure, during the dot-com mania, all the way to the peak, Berkshire Hathaway underperformed. The Nasdaq was up triple digits. Berkshire Hathaway was up a little over 50%, at least if you look from 97 to the peak of the dot-com mania. But then what happened? The dot-com came and go, and since the peak of the dot-com mania, Warren Buffett, Berkshire Hathaway, is smashing the Nasdaq. Not even close. Gains of over 1,000%. Nasdaq since the peak, up triple digits. Big deal. What is the lesson here? If you have an investing style that's been working for you, you stick with it. I have mine. It's been working for me fine. I'm not going to invest based on the emotions and the crowd sentiment. If these stocks want to go higher and go crazy, be it. So be it. No problem. The higher the better. I'll short them later on. I'll book the profits. In the meantime, I'm sticking with what's been working for me for years. Anyhow, folks, we're going to wrap this bedtime story right here. We're not going to go into the analysis and keep you up for too long. It's Super Bowl weekend and everybody is already exhausted. I think this conversation was heavy enough. Rest assured, if you happen to be a member of the channel, we'll do charts to watch before the open. I'll share with you charts in terms of short-term bullish, long-term bullish, short-term bearish, long-term bearish. And the reason is once the S&P 500 closes above a psychological milestone at 5,000, we might see a broadening of the rally, at least in the short run. So the short-term bullish charts are the ones you want to follow. If we see the rally stalling though and reversing, because it is overbought right now, we have a lot of economic catalysts coming, then you'll go with the short-term bearish. And then the long-term, that's for investment, either in the bullish side or the bearish side. So if you're interested in that, join us as a member. And I have a few other videos that I worked on over the weekend. I'm going to release those to you, but I'm probably going to be off for the daily show tomorrow, unless something big happens. Now, before we sign off, let's see what we got in the economic calendar this week. Monday, we have a bunch of Fed officials speaking, from Michelle Bowman and Minneapolis Fed President Kashkari. And that comes on top of the monthly U.S. federal budget. Tuesday, the 13th, will be a really important day because we have CPI. And then Wednesday, the 14th, we have, again, a bunch of Fed zombies here from Chicago, Austin Goolsbee, and Vice Chair of Supervision, Michael Barr. Thursday, the 15th, we have initial jobless claims. We have the Empire and Philly Fed manufacturing surveys. That comes on top of the import price index, retail sales, industrial production and capacity utilization. And then we have home builders confidence index. And after that comes a bunch of other Fred zombies, Christopher Waller, and from Atlanta, Bostic. Heavy day. Thursday, February 15th. Then Friday, the 16th, we have housing starts and building permits, really important indicators for the housing market. That comes on top of the PPI, the Producer Price Index, and the preliminary reading of consumer sentiment. Then, of course, more Fed zombies, this time around from San Francisco Mary Daly. So you know that this is going to be a heavy macro week, and things could change based on the data. So buckle up, folks, an interesting week ahead. But for now, if you found this video informative and helpful, please press the like button, subscribe, and leave a nice comment. But besides that, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
And it's important to remember this, that this is a pattern that repeats itself throughout history. Okay. See you next week.